Hello and welcome to the Stansberry Investor Hour. I'm Dan Ferris. I'm the editor of Extreme Value and the Ferris Report, both published by Stansberry Research.
And I'm Corey McLaughlin, editor of the Stansberry Daily Digest. Today we talk with Nick Maggiulli of dollarsanddata.com and author of the new book, Wealth Ladder.
This is a little different from our usual discussion, but I think you'll agree that this is something that you have to talk about if you have important wealth building goals in your life, and who doesn't? It's something everybody needs to talk about, isn't it? Well, let's do it. Let's talk with Nick Maggiulli. Let's do it right now. Nick, welcome to the show. Thanks for being here.
Thanks for having me on.
Yeah, you bet. I think, Corey, Nick was your idea to have on the show, wasn't he?
Well, I suppose so. Yeah, he reached, well, it was Nick's idea too. He reached out and is doing some promotion on this new book he's got out, and I gave it a read, and it's stuff I think that our listeners, viewers can benefit from. So happy to have you here. And I followed his work for a while too on of Dollars and Data.
Yeah, thanks for having me on.
Yeah.
So
I appreciate that.
Of Dollars and Data, that's your that's our guest's handle on X.com as well. And the book that Corey referred to, I believe, is called The Wealth Ladder. That's the one you're talking about, right?
Yes, correct.
Yeah. And I noticed that you got a little blurb out of Scott Galloway, no less.
Yes, I did.
Pretty heavy hitter.
Yeah. Well, I think so the wealth ladder is about, changing how you have to change your financial strategy over time. And there's different wealth levels. And the reason I thought Scott would be such a good blurb for this is because he's someone that grew up in like level 1, level 2, which is like, lower class, lower middle class. And then now he's ascended to, he's worth over $100 million, which is like level 6, right? So he's kind of seen both sides of that spectrum. And so I think having his experience and him reading about it, I think was getting a positive blurb from him was the thing I really wanted, because he's someone who's actually kind of experienced across the wealth ladder. Not everyone's done that. So yeah, that was the thing I really was happy about.
Okay, well, let's get into it. I'd like you to give our listeners a real flavor of what's in here, because it sounds like it's pretty darn useful information. I know I was having this conversation with my wife recently, maybe just in the past day or two here. And I told her, I said, my experience is that, of course, we know people handle unearned wealth like lottery winnings or inheritances extremely poorly. But the thing that really kills me is how many people handle the wealth they get from working their tails off for decades extremely poorly. And it's just, it's nothing you would expect, because you'd think they would appreciate what they had to do to get it, and they'd want to keep it. But a surprising amount of the time, that is not the case. So this topic, if we're doing our jobs right and we're helping make our listeners wealthy, they're going to need a dose of whatever you've got going on in this book. You've already intrigued me with these levels. Sound like socioeconomic, levels that you described. So I don't know. Dive in anywhere. Give me the bullet points.
Let me just introduce the framework with all the levels, and then we can go from there. So the wealth ladder has 6 distinct wealth levels. Why did I not call them rungs? Because rungs don't sound as good. This is a whole marketing thing. So there's 6 levels instead of 6 rungs. But each rung it's based on your net worth, right? And so as your listeners probably already know, that's all your assets minus all your liabilities. That's everything you own, like your car, your cash, and your bank account, your stocks, your home, etc. That's all your assets. You subtract out, any mortgage debt, student loans, credit card debt, etc. All your liabilities. That's your net worth, right? And you don't even need to have your exact number. You just need to know approximately where you are, because the ranges are quite large. So level 1 is less than $10,000 in net worth. That's level 1. Level 2 is $10,000 to $100,000 in net worth. Level 3 is $100,000 to $1 million in net worth. Level 4 is $1 million to $10 million in net worth. Level 5 is $10 million to $100 million in net worth. And lastly, level 6 is over $100 million in net worth. Now, obviously, just memorize level 3, which is $100,000 to $1 million in net worth. That's the middle class in America. That's about 40% of US households. From there, you can just divide by 10 or multiply by 10 to get to the rest. And, I came up with this framework, and the data by chance just happens to map onto this quite well, right? There's like roughly 20% of households are in level 1. 20% are in level 2, which is like the lower middle class. 40% are in level 3, which is 100K to $1 million. About 18% of households are in level 4. That's $1 million to $10 million. That's the upper middle class for you. Now, I know some are going to say, well, $8 million not upper middle class. Like, it depends where you are. I think in like New York City, that is like definitely you're doing very well, but you're still upper middle class. I wouldn't put you upper class yet. And then 10 million to 100 million, that's upper class. And then 100 million plus is like the super rich, right? And so the top 2%, that's level 5 and 6. And level 6 in particular, over 100 million, there's like only 11,000 people or households in the US that have that much wealth. It's very, very small. So there's a very long tail. That's just a high level context for understanding this. And within the wealth ladder, like depending on which level you're in, like your strategy might need to change to get to the next level, right? And so I think thinking through that and figuring out, okay, well, where do I want to go and where am I at now? And then thinking through what's the right, investment strategy, spending, income, like all these different things we can talk about within that. So I'll let you guys, I know this is an investment channel. We can definitely talk about the investments across the wealth ladder and like which levels tend to own which investments, etc. I can kind of dig in wherever you want.
Yeah. I'm less interested in that, which investments own which levels own which investments. I'm more interested in the, I don't know what to call it, the change in behavior, just the change in lifestyle and what it does to people and how you really, what advice you have for handling it. Like, Scott's A Great American Story, right? Level 1 to level 6. Amazing, right? There have to be, you go level 1 to level 2, maybe that's not a big change. Level 2 to level 3 strikes me as a fairly substantial change for most of the people who can swing it. It also strikes me as a level a change which would really, really require some dramatic change in how you behave to make sure that you can hang on to this and progress, beyond it. You know what I'm saying? It just the difference in the amount of money when you go 10x, like from 2 to 3, that seems like you need a serious helping of Nick Maggiulli to help. You need to get your Nick on to make it through there and to stay there. Is what I think I'm trying to say.
I think it really depends on timing is also a big issue in here. For example, when I talk about households in level 2, which is $10,000 to $100,000 in net worth, I really see two groups of people. I see people that are on their way to level 3 and level 4. They just haven't had enough time. You could imagine someone maybe came out of college, is earning has a good job straight out of college, starts doing well, starts getting promoted within the first few years. They may not have more than $100,000, very unlikely, even within a few years of saving, right? They don't have that money yet, but give them enough time, saving, investing, etc., with all the compounding, they're going to get into level 3, maybe even level 4, depending on how long we wait, right? The second group is a group of people where they just don't earn enough income, and so it's very hard for them to save. And so they may be even slightly older, maybe they're in their 40s or 50s already, and they're not seeing that progress. And I think, what's the driver of that? It's income. And I can go into that, in terms of, like the median income of a level 2 household is around $50,000 a year, which is, that's below the median household income in the United States, which is $70,000 a year. So it goes to show like it really, income is the driver of a lot of this stuff. And that's what the data shows. And so of course, behavior matters, and we can get into that as well. But I think income is the driving factor.
Okay, that's a great point. That's exactly the kind of important thing, because you might not know that. If we sort of sense that as Americans, get a good job, make a lot of money, income is the driver. But to hear a guy like you say it, who's done the research, is a little different and carries a little more weight. So tell me about that. How do I think about my income to get from 2 to 3 or 3 to 4 or whatever, in that medium range from doing okay or not so okay to doing really well? I just have to spend less than I make, right? That's all there is to it.
Well,
right?
that's for the saving piece of it. I think the problem with it's not, there's not a problem with that argument. It's just you can only cut so much. It's really tough, especially right now with rising prices and everything, to say, oh, I'm just going to keep cutting. Like, it's really difficult to keep cutting spending. And so because there's kind of like a lower limit on how much you can spend to survive, like, your income doesn't have the same limit. I mean, I'm not saying it's easy. Oh, just there's no magic wand that just raises your income. But
Right, just
if
turn
you
it up.
work on something or spend time, etc., you can kind of work toward that. And there's, in terms of how you raise your income, there's a lot of different ways we can discuss this, right? There's like a couple skills that I think are going to keep being valuable even in the future. And people are saying, well, AI is going to take all the jobs. Like, it's going to take some jobs, don't get me wrong, but it's not going to take everything. Like, I think, for example, sales. I think sales jobs are still mostly going to be done by people, right? Especially in person. I can't imagine a world where your realtor is a robot and you're like, oh, perfect, the robot just showed me. No, you're not going to get that feel. You're not going to have that personal connection, that touch that I think individuals are going to have. So I think high level sales is still going to be a very valuable skill to have in the future. And that's not something you can necessarily go get a degree for, but it's something you can learn how to do sales, learn how to get better at it, and go from there. That's one example. Another, I think, is credentialism. And so that means like getting a professional degree. Like, I know they're saying, oh, we're just going to use ChatGPT for, lawyers and doctors and everything. And I think it's helpful, but I think at the end of the day, you're going to go hire a professional, because you can't risk some legal loophole or some massive medical decision on an AI chatbot in the hopes that it didn't get something wrong, And so I'm not saying that they're not useful and they can't help, with the opinion of a doctor, but I think as of right now, trusting them completely for a legal opinion or something is not the way to go, because experts out there have used them and they still make mistakes. So these are just a couple examples of like, if I'm trying to raise my income, what are the types of things I can look into? What are the types of skills I can learn? And there's far more than that. I just want to give you guys like a taste of like how to think about this in terms of raising income.
Okay. Go ahead.
From reading the book, once you get above that $100,000 net worth, one of the things I think you point out is like this important shift to income producing assets. So like, what are the challenging or common mistakes maybe people face when they're or encountering this for the first time, or do people what do people not understand about that shift?
Yeah, so I mean, in addition to raising your own like income from labor, you're right in that you can also buy income producing assets, which will, give you income. That also helps build your wealth, right? That's the whole idea of compounding, investing, etc. Right? Like, your money's making its own money, right? And in terms of the mistakes people make, like in my first book, Just Keep Buying, the mantra of the book was the continual purchase of a diverse set of income producing assets. So I think all the mistakes are things that like go against that mantra. So the continual purchase means like just keep buying over time. That's literally the title of the book, right? I think when people start to market time and stuff like that, it can get very difficult to like try and beat the market, and you can actually make really bad mistakes. I think we've seen that. If this year, with the Trump tariffs, everyone was like, oh my God, the market's going to hell in a handbasket. And it came back. No one would have predicted all that, the fastest reversal ever, or whatever they're saying. And think about 2020, 2022. There's so many different pieces of history or evidence I have where it's like, it's very hard to predict the market. It's very hard to market time. So that's one of them. The next thing, concentration, right? As I said, the continual purchase of a diverse set of income producing assets. If you're all concentrated into one asset class or one particular individual ticker, it can be very difficult to build wealth because that thing can go down a lot. And of course, there are exceptions to that rule. If you had put all your money in NVIDIA 10 years ago, you'd be doing quite well today. But for every NVIDIA that's done well, there's so many other stocks that haven't. And so it really, diversification matters so much. Like I'm benefiting from NVIDIA because I own it through an index fund. And that's how I think most people should be investing. Now, I'm not saying there's anything wrong with having a small amount of money and picking stocks and all that. I think that's great. It's fun. I actually encourage people to do that. But I think the vast majority of their wealth should be indexed, right? And then lastly, income producing assets. I said the continual purchase of a diverse set of income producing assets. I think people can also get in trouble when they start putting most of their net worth into non-income producing assets. So things like you're just trying to, playing, crypto and altcoins and all this. And don't get me wrong, Bitcoin is the one exception to this. But if you keep day trading and all these many other altcoins, you could have lost a lot of money. I hear so many stories of people who've lost 70, 80, 90% in these random other cryptocurrencies. So, if you want to do that, you can keep it a smaller percentage of your portfolio and then let the most of it be indexed and just keep buying over time. And I think that is the fundamentals to build wealth. And when you move away from that, you start running into problems.
I agree. I'm not sure I agree about the indexes, but I completely agree 100,000% about, especially at this time, the absolute need for a well and truly diversified portfolio. We just recently talked with our colleague Alan Gula about this very thing. This is like my style of investing, and we talked about things like your stocks, your compounders, your sort of get rich stocks, your stay rich stocks, T-bills, managed futures, Bitcoin, even bonds, all kinds of things, just to make sure that you are um, sort of loading up, as you say, on constantly, loading up on these income producing assets. Gold's not income producing, but holding them can sure feel good when they're performing well and other things aren't. So that's the point,
Oh,
of
oh
course,
yeah.
is the correlation, less so than the income. But income is an interesting idea, and it's not, you're not the first person I've heard really advocate for constantly picking up income producing assets. What about things like, real estate, or, privately held things, not necessarily a publicly traded company that is income producing? Do you do you own real estate yourself? What do you tell people when they ask you about it, I think, is the real point of this question.
Real estate falls under income producing asset for me. I think I own it through REITs just because they're diversified.
Yeah.
Obviously, the diversification is nice because you kind of get a broad exposure. The bad part is like if everything's going down, like right now, a lot of my REITs own commercial real estate. A lot of that's struggling a lot more than maybe residential would have, right? Because
Mhm.
of the not many people are coming back to office, COVID, all that stuff, right? So I own REITs pre-COVID, right? So when I think about that, those are the types of things. So I think real estate, owning your own business, having your own products, private businesses, all that stuff counts as income producing, in my opinion. So there's just different flavors of it. So I have nothing against any of those methods. So it's a very broad definition on purpose because I've seen people get rich in real estate. I've seen them doing it with individual stocks. I've seen them do it with index funds. And so it's really, I prefer index funds, and I have nothing against those who want to go and pick stocks and do that. That's fine. I just know for myself in particular, it's not my thing I'm good at. And so I'm far better at spending my time putting out financial content to help people and writing and doing all that versus trying to beat the actual stock pickers who are good. Right. And so that's just my personal like counter, to that is like, I can't do it. So I don't spend the time. And I think that advice would suit most people, but those who are still think they can do it or are decent at it, they should do it, right? We need stock pickers to help the indexers. Like we free
Sure,
ride off you
sure.
guys, right?
Right.
So
All right. So I didn't want to de-emphasize the, individual investments, though, like I said, because one thing I'm really interested is what Corey touched on a moment ago. Like, for example, I'm a big believer in via negativa. The learning of life is about what to avoid, and you're nodding your head, so and that's really, to me, once you get to levels 3 and 4 and et cetera, you really are focused a lot on keeping what you have, as much as at least as much as building. You may be a very growth oriented, building oriented person, but you still have that responsibility of keeping what you have. So actually, with both of those goals in mind, the growing and the keeping, like, um, what are there some obvious mistakes, maybe, or not so obvious mistakes that people make when they're, they get into level 3 or they get into level 4 or something? Do you see, is it as simple as don't buy a Ferrari right away? What's the advice?
I think every level is different. So if I say what I think the mistake is, the spending mistake in level 3, I think it's probably spending too much on big purchases. So that would be like, I think someone in level 3 is probably not getting a Ferrari, but maybe they're buying a car that's nicer, trying to look and show off a certain lifestyle. I think that's a piece of it. Getting a house that's too expensive. And in the Wealth Ladder in chapter 10, I kind of talk about mobility, and so like how people change wealth levels over time. And I compared the people who were in level 3 that stayed in level 3 over a decade to those who were in level 3 and made it to level 4 over a decade, and say, okay, what's the difference between these groups just based on the data I have? The one thing I saw was those that made it to level 4 had a higher starting income. So that's a piece of it. But the other thing I noticed was those that stayed in level 3 spent almost as much as those who made it to level 4. So those who made it to level 4 had a higher income, and they did spend a little more than those that stayed in level 3. So there is some general correlation between income and spending. As income goes up, spending tends to go up just a little bit more slowly. But the people that stayed in level 3 over the decade, right, they ended up spending almost as much as the people who made it to level 4, despite the fact that they had a much lower income, right? And so I think it's that overspending can creep up on people. And I think that's why I say, level 3 is the middle class, level 4 is like the upper middle class. And I think they're actually very similar lifestyles. The only difference is in level 4, people are just kind of getting the slightly fancier thing, right? It's like the Lexus versus the Toyota, or the slightly nicer seat on the airplane, right? If you're in level 4, you're not flying private, right? You can't afford that. So if you start thinking through all that, it's like, okay, I can upgrade all these things and like look like I'm in level 4, even though I'm in level 3, and that can actually hold you back, ironically. That's one of the things I think about there. And level 5 and 6, I think the big issue is just the over concentration. Like usually to get to level 5 or 6, you need some sort of a large amount of business ownership, or you owned one individual stock and it just became 100 bagger or something. Now you have over $10 million in it, etc. So something like that, where you really just put a lot of money into something and now it's just a huge part of your portfolio. And if you don't diversify and something happens to it, you could end up losing a lot of your wealth. So I think those are the types of things to think about in those higher levels.
Well, this is interesting. I'm glad you brought this up, because it seems to me like every single person I know who's level 5 or better did get there absolutely by focusing their wealth and their time and their energy and not doing a whole lot of other stuff, which I know you've written a recent piece about that. I want to get to that too. But and yet we're saying, hold a diversified portfolio. There seems to be a contradiction there to me, especially the trip from level 3 to level 4. No?
Yeah. So I don't know. I think you can make it to level 4 while being diversified. I don't think that's the issue. I think I agree with you if we're talking level 4 to level 5, because I think you're correct in that it's very hard to have a diversified portfolio and be in like level 5 or level 6 or something like that, right? The only people I know who've done that already made it there and then sold out of those positions and then diversified. You can think like, compare Bill Gates to Elon Musk right now. Yeah. Bill Gates is very rich, but he's like massively diversified. I actually think he's richer than Musk. And I know on paper, Musk is much richer, but he has so much concentration in just Tesla. Like if Tesla gets cut in half, or go even worse, like he's going to lose most of his wealth, while Bill Gates, right, would be fine, even if Microsoft were cut, in half, etc. So I think because of that diversification, Gates actually has a lot more wealth, even in no matter what scenario happens. And so that's kind of how I like to view it, because he's diversified, and even if Musk tried to sell all his stuff to diversify, he would end up crashing the stock price and causing all sorts of other things. So I think thinking through that is the big thing to focus on. And so I think you need to have, diversification to stay rich, basically. But if you want to get incredibly, incredibly rich, you probably need to be concentrated at some point.
So that has to be, correct me if I'm wrong, that must be a major theme for you, in your advice and your writing and research of getting to level 5 and 6,
yeah. Go ahead.
No, I'm just saying, I think we agree, maybe mostly you can only get so far by, having a good job and having a diversified portfolio that you never stop buying, right? Never stop buying. Or just keep buying. Sorry, I had the title wrong. That you just keep buying this diversified portfolio. You got a great job. You spend less than you make. That is very different than what it takes to get, 10 million, 100 million.
Oh, it's very different. Besides celebrities, athletes, entertainers who just have really high incomes and can make it into level 5, you basically have to do business ownership. And if you do the math on this, it's actually insane. For example, let's say today you had $1 million portfolio, right? So you already have to get to $1 million, which is not an easy feat. It usually takes people their whole lifetime to get there sometimes. So let's say you have $1 million portfolio. Let's say you're adding $100K a year to it after tax, right? And on top of that, you're getting 5% a year. I'm just doing that because it's a conservative, say, diversified portfolio return, right? Do you know how long it would take you to get to 10 million? The answer is 28 years. This is while you're adding $100K every single year.
Yes.
And like, that's a lot of money. And so you're like, well, Nick, what if I got a really good paying job and I'm saving, let's say, $300K a year, right? You're saving $300,000 a year after tax, an incredible amount of money. You're saving that. You start with $1 million. You're earning 5% a year. It still takes 17 years to get to 10 million. So you can see, like, you're basically in the no man's land of wealth. Like, you know, it's like in Succession, where he's like, you know, 5 to 10 is a nightmare because you can't get out of there. And I think it's true. Like, once you get in there, it is very difficult to get out. There's nothing wrong with getting out. I don't think you need to get out. That's a whole philosophical debate we can get into. But I think the tactics that got you into level 4 are not the tactics to get out of level 4. And a lot of people may not necessarily realize that. And so that's a big theme in the wealth ladder.
Yeah. Yeah, you bring up a good point. I mean, at some point in this discussion, you have to get to the how much do you really need? And I know you wrote a recent piece. It's like, I think it's hours old as we speak and record here, about this, about financial, you know, the desire for financial independence is the topic that you addressed. And what about that? Is it simply a matter of saying most people would be happier if they just had a well-balanced life, good job, save, have a diversified portfolio, and don't worry about what level you're in? Is that the message?
I think that's closer to the message. I'm not saying don't worry about what level you're in. I think if you're in level 1, that's like, you got to get, I think you got to get out of level 1. Yeah. I mean, it's only because you don't have the safety. You don't have but once you get out of level 1, you have a little bit more calm. And then I think most people, at least in the United States especially, should be in like level 3. I think that's where you can really, you know, not worry as much. You're going to probably have savings for your retirement. You can have other wealth you can pass on, etc. And then by the time you get to level 4, that's when you can really chill out and be like, yeah, I don't really need to worry about money anymore in the traditional sense, unless you have like a really high spending habit or something. So I think, you know, my favorite level is level 4, because I think that's the spot where you can have enough money to not have to worry about a lot of different things. You can have a good life, all these different things, and you don't have to go for more. I really believe it's the enough area. Obviously depends where you live. If you're in a low cost of living area, you can do that in level 3 easily. If you're in a high cost of living area, you probably need to be level 4. And so just thinking through that is where I started to think about these themes and when does it matter? When do we move forward? And in terms of that blog post you talked about, which is like, I said, why financial independence is overrated. It's not that I'm against financial independence. It's just, I think some people chase that as a goal and like, oh, I just got to get to financial independence without thinking through like, okay, what are you giving up along the way? And so I have all these examples of people that, you know, don't hang out with their friends, don't talk to their family just because they don't want to spend money or anything like this. And not any things, a lot of these things don't even cost money, but they're so focused. Well, I got to work. And so they end up overlooking all these other parts of their life. And so, yeah, even in the wealth ladder, when you get to level 5 and 6, the things I focus on aren't money related at all. It's actually all the non-financial things. And so that's how I keep the book interesting for someone, because I don't think I'll ever make it to level 5. And yet I still want to make that chapter interesting to people, because it's like, what are the things that actually people in level 5 should focus on? And I really believe it's all the non-financial parts of their life, because they already won the money game. Like, you can't buy, you know, your spouse's love. You can't buy a new cardiovascular system, right? Like, so money at some point stops becoming as useful. And so you have to realize you still have to put in the time and effort to make the rest of your life very meaningful. And so that's the thing I like to focus on there.
Yeah, that was one of the things that I love that you got to in the book, just that age-old question, right? Can money buy happiness? And you address that. We don't need to give away all of the answers, but the part of me also thinks is like, you know, the people in level 3 who might be spending more than they should if they want to a higher net worth into that level 4. Maybe it's okay, you know, if people are just happier at that level too, you know, like there's something to be said for that. You're just kind of, you know, I know there are a lot of people that aren't as into or thinking about money and investing as much as we are. So maybe that's part of it too, but I guess what's maybe one or two takeaways from that discussion about, like, can money buy happiness that you might be able to share here?
Yeah. So the original, I'll just walk through the research. It's fine. We give a little away. So thank you for listening, everyone. So the original research was like, hey, you guys have probably heard it. Like, once you make over $75,000 a year in income, you know, happiness doesn't increase anymore, right? a guy named Matthew Killingsworth came back and he put out a different piece. He looked at, did a different survey, and he found actually no, like happiness keeps increasing, but like the jumps get bigger and bigger, right? It's like you have to go, it was a logarithmic, so like a 2x, 3x, 5x, almost like the wealth ladder, like a 10x jump to see more happiness, right? It's like the dollar amounts to get more happiness just kept increasing, but he kept finding more happiness up the scale. And so he's like, okay, what's going on here? So he looked at the original data, they went back and forth, and they basically determined that the first study was only looking at unhappiness, preventing unhappiness. So I know that's a weird, like kind of double negative, but the idea is after $75,000 a year, that's like making more is not going to prevent more of your unhappiness. You can still be unhappy making more than that. And everyone knows that. It doesn't matter how much money you make, you can still be unhappy at any
this
level
is
of
that
income.
Daniel Kahneman, right? So,
yeah, that's the
the
Kahneman Deaton original study. Ago, right? Exactly. Yeah. So they went back, they looked at it again, and now basically it's been settled. They looked at their data and they agree. So the new research is basically, I'll just give you the punchline. If you're happy, more money is likely to make you happier. So if you're already happy, more money is likely to make you happier. If you're poor, more money is likely to make you happier. But if you aren't happy and you aren't poor, more money's not going to do a thing. And I think that third category of people is the category who can be chasing for more and more, and they're already unhappy because of something else in their life, and they think money's going to fill that hole, and it doesn't. And that's the real kind of wake-up call that they don't realize until maybe it's too late.
Well said. That is we've all heard of that, the $75,000 limit. In some form or another, but it's usually that particular one. And it makes a lot of sense, right? You're levels 1 and 2, you're getting out of that to avoid unhappiness, to avoid misery, right? And once you've done that, you've met all the basic needs, and it probably gets harder to make yourself happier. Like you said, it's like 10x or something for the next jump in happiness. But not being happy at any level, no amount of money is going to do it. That's
right.
That's
exactly,
the one.
Dan. That was the takeaway from that whole section. That was like, if you are happy, money will help, but it's not going to. It's not the solution. It's not the answer, right?
I think a lot of people that look at this research, like, I'm not saying a lot of people are unhappy, but I'm saying that people like, oh, I'm not happy. Would more money solve my problem? If you're poor, the answer is probably yes. Right. But if you're not, like, in like level 1, let's just say, the answer is probably no. So that's where I think that's my like at least minimum. If you're not in level 1 and you're like, oh, I'm not happy, it's probably not money that's the issue. Like, that's the simplest way of looking at this. You're like, oh, I'm in level 3 or 4. I'm in level 3. I need to get to level 4, then I'll be happy. I'm like, no, that's not going to do it for you. I'm sorry. I don't think that's the difference. So,
yeah. This is a funny topic because I'm sure a lot of people are nodding along. But I would bet, and I don't know this for sure, it's just based on, being 63 and running into many, many people for 63 years of life and knowing myself and those around me. This is the sort of thing that we know and might not act on as much as we would like to think. The knowledge is there. We know it's not going to make us happier, and yet we continue to strive for it. Humans are a funny species. I think it was Nathaniel Branden who said, we're the only species that can, think about the right thing, learn the right thing, know the right thing, understand completely the right thing, and go and do the exact opposite.
I have a theory for this, at least in the money department. I can't say that on everything out there, but I think with money, my theory, which I kind of put forth a bit in the wealth ladder, is money is the most measurable thing. Like, we can all open our bank account app on our phone right now, and there's going to be some number there, or your brokerage account, right? You can see that, right? If I said, hey, what's your cardiovascular fitness right now? Okay, maybe you did a VO2 max test or something recently. Maybe you worked out. Like, you could start to figure it out, but it's not as easy. Like, anyone can tell you their bank balance. Not everyone can tell you their cardiovascular fitness, or how well is your relationship with your family or your children or your spouse or whatever. Like, because all these other things are not quantifiable, it's very easy to focus on the quantifiable thing. It's almost just like a very, money has created a very simple game for humans, which is like, follow, do things, make number go up, right? It's like, if I could really dumb it down, that's literally it, versus like, oh, hang with friend, make myself happy. Like it's not as clear cut, but that is technically a better solution to get at a lot of these things.
Yeah.
And like and we don't think about that, but that's because it's not as measurable. You can't just be like, oh, look at how tight my friendships are. It's kind of hard to measure that. So
we do. Modern life is and, it has this aspect to it where you think that anything measurable matters more, but the truth is not everything that matters can be measured, and not everything that can be measured matters. And again, though, there's an availability bias. The numbers are in your face, your bank account and so forth. It's all in your face, and factual data can be, just you're pummeled with it nowadays, via internet and any other source. But online, you're pummeled with data of all kinds. And those other things, they do feel very soft. It's like, no, I'm not going to, maximize my portfolio or whatever. I'm going to go hang out with my friends. It just, it sounds like a mistake. Even though we know, hanging out with your friends is good, and striving for money after some point is not good. It's still there. The factual data-oriented nature, people like to say they're data-driven as investors and thinkers in general, but there are plenty of things that can't be measured, aren't there? I mean, that seems to me like a big lesson that a set of ideas like the wealth ladder would have to relay to people. I wonder how many level 5s and 6s are in desperate need of that message.
Yeah, and that's the funny part, is they probably won't listen. But I think I understand why, though. I understand why, because they'll look at, me putting out this message, and they're saying, you never built a business, you never done all the successful stuff. And they're right. I have not done any of those things. I'm not successful at doing those things, right? I'll be the first to admit that. Mm-hmm. But just because you've had success in a field doesn't mean someone else can help you realize the things you're overlooking. That's all I'm saying. I'm not against people building businesses. I think a lot of these people enjoy it. That's why they do it. And that's why they don't stop. Very few people are like, oh, I just want to get to, let's say $20 million and then never work again. Very few people that get there. Those are the people that want to keep going. They don't want to stop at 20. They want to build a bigger business, and it's a challenge for them. So a lot of them enjoy that, and that's fine. I do think you need to focus on other things in life too, because there's more to life than just that. And so I think overlooking that is the quote. Every wealth level has like a sin of the level. And so level 5 and 6, it's overlooking the non-financial parts of your life, which those are important everywhere, but they're the thing you can't replace with money in any capacity at level 5 and 6. And that's the scary part.
Right. You've gotten where you are based on focusing and frankly sacrificing some of those, moments. And then all of a sudden you're going to change that and that's going to feel right. That's got to be incredibly difficult. And I know, we could probably all tell stories of our, wealthiest friends getting divorced and so forth, or worse. And it's difficult. People, like I said, unearned wealth, people handle it poorly, but even earned wealth that people, work their lives for, it's not just a matter of handling the money poorly. It's a matter of not being able to step back and say, okay, when is enough financially? But then you run into people like, Warren Buffett, who is certainly a hyper-focused person who has said, I realized that I gave up a lot of other stuff. I've never heard him say he regrets any of it. Maybe I'm not reading the right books about him, but, I think that's highly unusual. And I think most people do learn to regret some of the experiences that were, foregone in favor of the focus and the drive and all the rest of it.
Yeah, and I think Warren Buffett has a certain image that I don't know if he's doing it on purpose to come across, but he doesn't talk about his personal life as much. Even in the documentary, he's talking about his family, his children, obviously him and, his wife were estranged at one point or something. And then he had the second wife, so there's a lot of stuff. And I don't really, I'm not here to talk badly about Warren Buffett in any means. No. I think he's kept that close to the vest because it's his private life. And I think, he doesn't want people talking about it and stuff like that. So I understand why he doesn't talk about that, because I think he wants to be remembered as, the greatest investor of all time, which he will be remembered as. But I think he doesn't want as much of his personal life in there. So and that makes sense. Who no one wants their personal life out there for everyone to judge and dissect and all that. So I completely understand his perspective.
Yeah, I suppose the point for me was that an individual like that who, let's say I'm right about this, and he really seems like a happy guy. He does not seem like a man filled with regrets at all. But we know that he, like a good Saturday night for him is to get a stack of annual reports and a Coke and just, stay up till midnight reading them or whatever. And, over and over again for years and years and years. I mean, he's taken in probably more financial information than any living human being ever, right? Just endlessly, constantly, relentlessly. And it made him, and, he says, I tap dance to work. It makes me happy. So what I want to underscore is the extreme rarity of that and the high unlikelihood that kind of, drive and focus and these folks who work these crazy, like iBanker, investment banker hours and lifestyles. I think many more of them are headed for a burnout and a reckoning than realize when they're, 25 or 30 or something. It's just highly, highly unusual. And maybe that's why it's highly, highly unusual to get to level 5 or 6.
Very true.
Yeah.
Yeah.
Yeah. So, and I guess it's different for everybody, right? I mean, and that's everybody's different too. The measurables are the same, if you're measuring by net worth and dollars, but how everybody goes about it is different. And I'm guessing if you ask, Warren Buffett's family members or friends or, some other people that are closer to him, they might get different answers about what he was like to them or whatever. And you get that with anybody, really. I mean, so, you have an image, especially public figures, you have that public image. And, a lot of business owners have this too. A lot of business owners, or some are, and we have them in our audience, like are big personalities. There's some aren't, everybody's different. So I don't know. I just thought this was a fascinating framework that you had in terms of like how each of the levels have their different trademarks or signatures about, or advice for how to get to the next one. And then as you get older or as you get higher, like really it's not, the money's not solving, these whatever deep-seated issues that you have. And if you want to protect it, at some level that becomes important. Like that's an important thing. Or what do you want to do with it once you have
exactly
it?
Yeah. What type of impact do you want to have? That all matters everywhere. But yeah, I just wanted to come out with a different framework. I wanted to come up with something new because, I don't want to just put a book out just to put a book out, right? And like, just keep buying that's not a new idea, telling people to keep buying into the market. Like that's a very, Vanguard-esque Vogalism type thing.
Yeah.
But, I did it with new data and trying to show, hey, look, I analyzed all these other markets and it works here too. And this and that. Right. And so now with this, I'm like, hey, let's look at the wealth data. Let's see how people actually build wealth. Let's look at it over time and let's go and create some sort of framework that makes it easy for people to realize when they should consider changing strategies, et cetera. And so it just it just happened to fit so naturally with the the actual economic data of wealth in the United States, which I loved. So yeah, that's kind of the way I came up with it.
So let's each do this. I'm not going to, we're not going to give away details about our personal net worth or anything, but let's each tell our audience what mode we're in with this. Like, I'm never going to be Porter Stansberry. I'll go first. I'm never going to be Porter Stansberry. I'm never going to build this, company that's worth hundreds of millions of dollars and really consolidate a crazy, fragmented, insane industry. I mean, when he started in it, it was like ripe for dramatic change. And thank God he came along because it was a mess. And he did, incredible work, really focused. And I'm not that guy. I'm more of a balance of life person. I'm, knock wood, I've been successful. Hopefully I'll continue to be successful, hang on to what I've got, in large part thanks to Porter believing in me. And that's where I am. I'm, no matter what my number is, I'm more of a a life balance guy. Corey, do you seem like you might fall into that category too?
I am, and ideally I want to be. I also I'm like on the younger end here and have a young
Yeah.
family. And so I'm
Right.
trying to, you have pressures there. It's just, inflation is what it is. And, I mean, I knew about inflation before COVID, but I really know about it now. And, from where I started was essentially knowing nothing about money at all. And was definitely at level, I mean, I wasn't in poverty, but I was not in level 3 or anything like that. And so, just, I grew up comfortably, but I didn't know what it takes to actually, like, these things that Nick outlines in his book. Like, I had no idea about it. I'm still, and I'm still learning a lot. And so, that's kind of where I am. I like to have a stable kind of, for whatever reason, whatever psychological reason, I like to have some sort of stable foundation first before, embarking on something new. So, like, like when I first got into investing, I was like, all right, maybe I'll just make a ton of return in whatever I invest here. But I was starting with such a small amount that really didn't make a difference. Or eventually it hasn't made a difference. But and then eventually I got to a point where, hey, I need to make more income here to facilitate all this stuff that I think I know. Anyway, like I could have the greatest stock pick in the world, but if I can only put $500 into it, that's not going to really be a life-changing decision. So that's kind of how I look at things now. I like to have a build up that foundation of stuff, like of assets that you can, through income producing assets, and just kind of keep compounding that way over time. And thankfully, I've learned this stuff as I'm relatively young, so hopefully it pays off in the longer run. But there's a lot of pressures, I think, having on the younger end, having kids now and wife, and trying to figure out all that stuff too, and keep everybody happy. But yeah, that's why I think this book, like, just is, or this a framework, even whatever framework you have, it's important to have one to kind of get yourself on a some sort of path, whatever path you want.
Right.
You just know how to get there.
So,
yeah.
So what about you, Nick? Are you obsessed? Are you on your way to level 6? Or are you more balanced?
No, I don't know. Unless I end up selling 100 million books, which is not going to happen, that's the only way I would end up making it to level 6. So unless every household in the United States bought this book. But no, I'm very, very similar to Corey in that sense. I just got married, right? I'm 35 years old. I'm now about to start the family process and all that, God willing. And as a result of that, that's going to, there's going to be pressures there to help with that. My parents are a little bit on the younger side. So they're only, they're barely, I think, 59 right now, 58, something like that. So they're going to be 60, I think, next year. So because of that, they're a little bit younger. And so, I'm waiting. I'm going to probably have to help some of them a little bit financially. And then in addition, I'm going to have my children and stuff. So like, I'm going to have this kind of squeeze thing going on, not yet, but in the next, probably decade or so. And so thinking about all that, and like my liabilities are about to increase significantly. So it's more for me, just like I'm working, just like I enjoy it. I love what I'm doing and everything. But yeah, I'm not trying to get to level 5 or 6, just trying to, do my thing and enjoy the work I produce and try and help people. So
right. And keep your family well cared for.
Mm-hmm.
Yep. We're just too sane. If there's level 6ers out there, aspiring level 6ers, or they probably turned us off, 35 minutes ago or something.
I mean, I need those people, because those are the people that create businesses that help, change the world in positive ways. And I benefit from that by owning an index fund that would, assuming they go public in some way, then I get some benefit from that. So I'm free riding off these people, creating these ideas and putting this stuff out there. So I appreciate those people deeply.
Yes.
But yeah, that's how it works.
Yeah. This discussion, like, it's such a healthy one to have. It really is. It really is good to, because we think we know these things, but we say, yeah, I know, but, I want a nicer car. And those moments, and you said something I've told my wife many times, it's it's the big stuff, the big spending is where you go wrong. People don't get this. I remember years ago, I wanted to buy a bottle of wine that was like $70 at dinner. She was like, $70. I said, hon, it's the big things where people go really, really horribly wrong. And so, penny wise and pound foolish, right? That saying makes sense. And I'm gonna, next time that comes up, by the way, I'm gonna definitely say, Nick says so. I mean, it's not just me, right? Because spouses don't listen to each other. So Nick says so.
We actually didn't talk about the spending stuff much. So basically every wealth level has like a level of spending freedom. So I'm like, hey, once you're like deep into level 2, I call that grocery freedom. So you can kind of buy what you want at the grocery store. Once you're in level 3, like deep into level 3, I call that restaurant freedom. You can buy what you want at a restaurant. Mm-hmm. Level 4 is travel freedom, etc. But the idea is like your wealth is generating a certain amount every day. Let's just make an assumption. I assume that's 0.01% per day, which on an annualized basis, you do that 365 days in a row. And that's roughly 3.7%, which is a conservative annual return, right? So if you assume that's true, your wealth's throwing this off. That's like a trivial amount of money to you. So for example, in the example you gave with the $70, that would be like if you had a $700,000 like total net worth, your wealth would be generating $70 per day. You can buy that bottle of wine one time and it's not going to bankrupt you at all. So That's the way I like to frame it. And that's kind of what I talked about in the book. So I like using that framework when I'm thinking about things and I'm like, it's like, oh, but I don't want to spend the $20 or the $50. And I'm like, and I tell sometimes my wife, I'm like, baby, like using the 0.01% rule, we should not worry about anything below this amount. Right. And that's kind of what I like to talk about there.
Yeah, man, just don't buy the Ferrari and you'll be okay.
Yeah. You have to have a lot of money to do 0.01% on the Ferrari.
Yeah, exactly. Just don't buy the Ferrari. Don't buy too much house. Don't buy, too much car. Those are the big ones, right? Too much house, too much car. And if you can keep that under control and spend less, just generally spend less than you make otherwise, avoiding big mistakes, like we can't say it enough, right? People, you start out when you're young thinking about wanting to get a good job and invest and do things that add positive, make positive contributions to your wealth creation ability, your net worth, and so forth. But like at some point, especially if you're me and you had a really tumultuous, 20s and 30s, you go, oh yeah, don't spend way too much on all the wrong stuff and don't focus on one asset and don't there's a million of them, right? And I'm very pleased that this book is that part of that discussion, and this book is part of that, avoiding doing the wrong stuff. So, well, now that we've established that we're just a bunch of boring wealth compounding, people in search of life balance, let's get you into our final question, which is the same for every guest. No matter what the topic, even if it's a non-financial topic, same identical question. If you've already said the answer, please feel free to repeat it. But it's a simple question. It's, for our listeners' benefit, if you could offer them just one takeaway, just one idea today, what would you like it to be?
Income is the foundation upon which all of your wealth is going to be built. That's the key, right? And it's the strongest relationship in all of personal finance. I've just looked through every data set I could, and don't get me wrong, spending matters, all these other things matter, but if you can get enough income, if you have enough income, your budgeting doesn't matter, right? Like it's the argument, but that's it.
Yeah. Nick, that is an awesome takeaway. We're constantly, like, some people think, well, I didn't get rich, this way, but I'm going to get rich in the stock market. No, focus on your job and your career and the value that you add. Build your career, build your income. And you can build it many ways, right? You can build it through investments, but build your income. Excellent. Thank you so much. And thanks for being here. I'm really glad you could join us and spend some time talking about the wealth ladder.
Thank you so much for having me on. Appreciate it, Dan and Corey. Thank you.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.